All right, in 1905, today we're going to be talking about the declining balance method of depreciation. So far, we've talked about the straight line depreciation, and today we're going to talk about another way that you can calculate depreciation expense. That's a little bit more realistic for some of the plant assets that we use. So remember that so far we've talked about the straight line method, which charges an equal amount of depreciation expense every year. However, there are many plant assets that actually depreciate more in the early years of useful life than in later years. And one of the best examples of that is any sort of automobile, a truck, a car, any of those types of things decrease more in value in the first year or in the first few years than they do in later years. Maybe you've heard the saying that when you drive a brand new car off the lot, it's worth half of its value. That's really what they're talking about here, is that cars depreciate much faster in the early years, which means that we maybe want to be able to charge a more accurate depreciation expense in the early years than the same amount each year when we do the straight line method. And that just goes back to that accounting concept we've talked about lots of times, making sure that we're matching our expenses with our revenue. Now, any method of depreciation that records greater depreciation expense in the beginning and less expense in the later years is called accelerated depreciation. And GAAP actually allows us to use either of these. It's whatever one best suits our business. Now, a very common accelerated depreciation method bases its calculations on the book value of the asset, which then declines each period. And the declining balance method of depreciation is a type of accelerated depreciation that multiplies the book value of an asset by a constant depreciation rate to determine annual depreciation. And I know that's kind of a lot of gobbledygook talking about that right now. It'll make more sense when we see it in action here on the next few slides. The declining balance depreciation rate is actually some multiple of our straight line rate. So we still have to kind of do the straight line rate, and then we take it and do the declining balance, which speeds things up, okay? And most businesses find that they use a declining balance rate that is 2 times the straight line rate. So that's where we get this double declining balance method. It's just depreciating 2 times the rate of the straight line method. So looking at this, if we assume that our estimated depreciation expense is 100%, right? We take that divided by our number of useful life years. For this example, it happens to be 5, which means that our straight line rate of depreciation is actually 20%. So then what we do is we take our straight line depreciation rate of 20% and multiply that by 2, and that's how we get that double declining balance rate. So now we're up to 40%, okay? Now we move over here and we start with an automobile, maybe it's a company car, and we have a double declining balance is our depreciation method. And we start with our original cost of $30,000, which is our book value, right? It's got estimated salvage of $250 and then estimated useful life of 5. So we take our beginning book value of $30,000 and we multiply it by the 40%, which means that our annual depreciation rate is going to be $12,000, which brings our ending book value down to 18. When we start year 2, that becomes our new beginning book value. And again, we take our book value times our declining balance rate of 40%. And now our annual depreciation goes down to $7,200. And now we're at an ending book value of $10,800. So you can kind of see how clearly your annual depreciation is going to change, but your declining balance rate stays the same. Whereas with the straight line method, our annual depreciation expense was the same every year. With double declining, that's actually going to change. Now, although the depreciation rate is going to stay the same each year, the annual depreciation expense declines from one year to the next, like we just saw. A plant asset, however, is never depreciated below its estimated salvage value, which is why it's very important that we know that. Therefore, in the final year, only enough depreciation expense is recorded to reduce the book value of the plant asset to its salvage value. So the amount of depreciation in the final year of an asset's life should be the amount needed to make the book value at the beginning of that year equal to the estimated salvage value. So let's see how that works. As you can see, as we start to keep going here, this is the same automobile we were talking about. On year 3, we have an annual depreciation of $4,320, so we get down to $6,480. We come over here, we do it again. Annual depreciation is $2,592, and we're down to $388. Now, if we were to do $388 times our 40%, it would decrease it more than its estimated salvage value, which is $2,500. So all we do in our last year is depreciate it as much as the book value is, subtracting out our ending, our estimated salvage value. And that's what our annual depreciation expense is, because we can't ever depreciate it lower than its estimated salvage value. We just don't do that. And so then we get our total depreciation, which is $27,500. And if you take our original cost of $30,000 minus our estimated salvage value, that's your total 100% of depreciation. Now, the double declining balance method of depreciation is one method of accelerated depreciation. There are actually many of them that exist. And all accelerated methods have one thing in common, that more depreciation is charged in the first year than in later years. Now, GAAP allows each business to choose which depreciation method it wants to use. However, once it's chosen, the business needs to use the same method from year to year. You can't go from straight line one year to double declining the next and then back to straight line, because that's not the accounting concept of consistent reporting, which means that we wouldn't be able to compare year to year because our depreciation expense would be calculated differently. Now, we also have something called MACRS, which is part of the US IRS system, and they have published rules that must be applied when you calculate the amount of depreciation expense that's used to compute federal income tax obligations. So this has to do with federal income taxes. And those rules that they've created are called Modified Accelerated Cost Recovery System, or MACRS. And MACRS is actually an accelerated depreciation method. And regardless of the depreciation method that gets used, remember that the total depreciation expense, which is 100%, is always depreciated over the useful life of that plant asset. And the accounts used in the journal entries to record depreciation expense and the sale of plant assets are also the same. So none of that changes what we've talked about in Chapter 19 so far. You just have to remember to check whether you're doing straight line depreciation or if you're going to be doing double declining. So here we can kind of compare the two methods. You're going to see that your total depreciation is the same over the useful life of that plant asset. It's $5,500 and $5,500. It's just notice how your ending book value changes. So at the end of the year with a straight line, your book value is $4,900, but at the end of the double declining, you're at $3,600. So it is quite a difference. However, you can see how they even out as you get down to the bottom, and your estimated salvage value of $500 is still the same. So we are ready to go over and practice the double declining method in Applia. So I'll meet you over there for our 19.5 work together.